I do want to just spend some time walking through one economic report, which many of you are probably already aware that has a real impact on the market that the market does watch. It occurs on the first Friday of every month at 8:30 a.m. Eastern Standard Time, and it's the non-farm payrolls report. What has happened is historically back in the old days, the the non-farm payrolls was an event that was very closely watched, and we used to see some very consistent patterns where price would consolidate into a very narrow range, and then when the report would come out, it would lend to some great trading opportunities. However, times have changed, and speculators have definitely changed that responsive environment at the time of the report, and I now highly recommend that you not trade into non-farm payrolls. But before we get into looking at some visual images of this, I want to walk through, just give you what you want to do is this is with each economic report that comes up, you want to do a little bit of a background on it, and you just want to sort of get an idea of what it means, why the investors care about it, and how it is going to impact the market and the overall health of the country. So it's good to have a feel for what each report means and why the investors care, and how it represents the economy. Because what it will do is it'll help you to get a feel for the market and the current market environment and the shifts in the environment. Because again, it's that broadened understanding of the market that's going to help you to trade effectively and help you to pick up on trades that you otherwise would not have seen, and help you to manage situations and maybe not get into trades that you otherwise would have. Of course, we are technical analysts, and the technicals do override and do take are the prominent contributor to our decisions when we are trading. However, the fundamental factors can absolutely interfere and certainly throw some of our trade management and speculative prospects off course. So it's important that you find a good resource base, and again, we do offer that through the Economic Reports CDs, a place where you can go and you can find out all of this information on all of the major economic reports. We're just going to have a look at a few examples of non-farm payrolls here, and here's a case where you see this trend here. This trend is several days before the report occurs. The market prices in what it is expecting from this report, and as you see, we see the pricing in quite rapid here, and then it slows down, and then as the report approaches, we start to get into this consolidation, and then a very narrow consolidation for the entire session prior to the report coming out. And then when the report comes out, then the number actually surprises the market. See here, we are pricing in an expectation. This price right here is the realized expectation of the market. That is, if the report comes out to the number that is expected to be announced. Now, if it exceeds expectations, we might see whiplash. We might see price continue in the same direction. But if it disappoints the market, and if it falls, in this case, it actually is above expectations, where the U.S. I'm sorry, it disappoints the market, and there is U.S. dollar selling as an immediate response, U.S. dollar selling, and it sells off 300 pips within 2 hours. Right. Again, here's an example where the market this is a British pound 2-hour chart, and the market is pricing in a negative number. So people are selling, traders are selling U.S. dollars leading into the report, and as the report approaches, price starts to just drift downwards. And again, in this case here, the number that is produced for the non-farm payrolls had exceeded the expectations of the market, and therefore what it did was it immediately gave back much of the built-in anticipation that the report would be negative. But here the report was positive for the US dollar, so here we see US dollar buying and British pound selling. Again, we see price now in this consolidation for one full day prior to the report. What this does to us is it actually takes away trading for a whole day as we wait for this somewhat nonsensical report to come out. And in this case, we see a positive US dollar report as the US dollar rallies against the British pound. But what happens is often after these big moves, number one, we have this consolidation that spoils a trading day. Then if we get a big move in response to the report, then often it takes several days for the market to work itself and begin to price in an efficiency and start as it focuses on the next stimulus that may come into the market or responds to current stimulus that is coming into the market in order to fairly price in the valuation of the currency cross at present. Here is another example, and price action is quite erratic leading into the report. Then again, one day out, for a full day out, we see price choppy and sideways. Then when the report comes out, we get this whiplash, taking in traders from either side, locking people into losses, locking trades into losses and significant losses, and or even taking you in and out of your trade literally within moments. Then again, we see how price continues to move up and down indecisively for a couple of days after the report, which is a really non-friendly trading environment for FX traders. Look at this one. We see for 1, 2, 3, 4 days of spoiled trading leading up to the non-farm payrolls as we move into this tight consolidation. And here in response, we have selling of euros and buying of US dollars, giving back what was priced in anticipation of the report. In this case, it was likely that a disappointing number was expected or a lower number was expected of new jobs, but in fact the number was higher than expected and the market priced it in an instant. This is an interesting scenario where we have this choppy price action once again waiting on the economic report. And when you see a wick like this, often what happens is there may be a leak in the news, or it may simply be a significant widening of the dealing spread at the time of the report, and then we see it reflected in the candlestick before the spread begins to narrow. And as the spread begins to narrow and we see primarily a weighting on buying interest, then we see a substantial move of a result of all of the buying. This is a 15-minute chart here, and we see as the market waits on the report, then as the report comes in, we see an immediate move downwards by about 80 pips, and then it goes down 80 pips, but then retraces 50, then goes down to the low again and retraces 50 again. Very difficult to trade. So if you're rolling the dice, trying to bracket the market or trying to straddle the market, then that can be very difficult. Usually best to wait 30 minutes to an hour after the report to see if an opportunity may present itself. For example, if you waited for quite some time after the report, here was an opportunity where price failed to move below the spike low from the report, and as it failed to hold below, there was a good buying opportunity. Try trading this one, folks. Here we had, sometimes we'll get this, we'll get an anticipatory move in the market where price moves 100 pips before the report, and as we get closer, traders get a little bit more concerned. They start drying up their positions. Liquidity dries up to effectively, to almost effectively zero, and then we have this wide spread that occurs in the market at the time of the announcement because there's effectively no buying and selling interest right at the time of the announcement. Then we get this whiplash as a result, shakes out countless positions, and then consolidates into the weekend. Again, this report occurs on the first Friday of every month at 8:30 a.m. Eastern Standard Time. We see a lengthy consolidation, very narrow consolidation for one full day prior to the report. When the report comes out, it rallies to this modest level of support, becomes resistance. By the way, this was also a central pivot and a 38% retracement on this specific day because I recall it very, very specifically before it's moved down. Again, if you were straddling the market here, you would have been taken in and then taken out of your trade. If you were straddling the market to the short side, then what would you have been doing as price was rallying during this stage before turning and falling down here? Would you have still had your order in? Unlikely, I would say. If you're waiting on this and price rallies like this, it's possible, if this is very decisive based on your evaluation of the market at the time, if it's decisive, you could sell when it starts to move below this low and commit below this low. You could sell it, but it all depends on the market environment at the time. Another non-farm payroll is very ugly and very difficult to profit in this environment. And I would say that your opportunity to profit based on if you're rolling the dice on a response from the market, it's very difficult unless you've done significant probability studies on when and how to make these trades. And we have actually done so, but you have to be very, very careful, and there are only certain times where I will make speculative entries looking for a response from the payrolls number. There's a variety of factors that I have to take into consideration. How much is the media pumping up a certain number? What are the various expectations built in by the various institutions, financial institutions, and how are they feeling about the market? How are things changing between the time of the announcement of the expectation and the actual announcement itself? Has the market trended and priced in an expectation, and does it leave a surprise side vulnerable? Because I like to trade the surprise side if it is left vulnerable.